Foot Locker reported earnings a couple of days ago and the market hated it, but I actually don't think it was that bad. And I think that there is potentially an opportunity, at least in my opinion. So as you guys smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. And so as you can see, Foot Locker dropped 30% this past week. That's a horrible 5 days, and it actually gets worse because if you look at it on a year-to-date basis, they're actually down 60% year-to-date. And so the question is, why would you be interested in a security whose share price just continues to go lower and lower? Well, as a value investor, this is the area that we play in. A lot of people, even value investors, were not interested in going into regional banks. That's where I ended up going into earlier this year. A lot of people did not want to go into real estate over the last 2 years. That ended up being very fruitful. And when I look at Foot Locker, I'm starting to get the same feelings as I did 2 years ago with Dreamfinders Homes. And you guys know that thing doubled or tripled or whatever it has done since then. And I'm kind of getting that feeling here where the valuation is just getting so low that it's just very unjustified at this point, and I'm going to walk you guys through that. And I just wanted to start with the results. And so overall, I didn't think that the results were that bad, but it just seems like there was a lot of income investors in the name, and they just left as soon as the dividend was paused. And so, here's where I got to fess up a little bit. Early on, like very, very early into my investing career, I used to almost exclusively invest for dividends. And my mindset was really, I would chase yield, and I was more focused on what the company could give me than focused on the overall health of the company. So I wasn't looking at their debt metrics. I wasn't really familiar with any of the publicly disclosed covenants or anything. Like, I just didn't care as much as I should have about the company that I was investing in. And I got burned not many times, but a few times, right? And you still remember it. And largely, I still think investors have that same mindset, or dividend investors, some, I wouldn't say all of them, still have that mindset where it's like, how sustainable is the yield? And that's all they really speak to. They don't really dig into the details and see whether or not the company has the potential or could be better suited to cut that dividend. And so one of the things we spoke about on the call that we have every month with the Patreon is that I thought that it would be a good idea for Foot Locker to cut their dividend. A couple of the people on the call thought that, they're probably not going to do it because if they were going to do it, they would have done it in the previous quarter. But everyone agreed that the company would have been better off if they did cut the dividend in this environment, especially if you cut the dividend and just pay down all that debt. So I'm really happy that they did choose to do that, because overall it is better for the company over the long term. And I love this quote, and I think it was from Warren Buffett. I'm not really sure, but it just said, don't own a share for 10 seconds if you're not willing to own it for 10 years. And over the next 10 years, I think this dividend cut is going to be very good for the company because, of course, they can fix the balance sheet and have capital available to address any downsizing that they would need to do and any capital initiatives to grow out the business into make it look like what it needs to look like into the future. And just going back quickly here, you can see that the second quarter, they did say, Mary Dillon did say, their CEO, that the quarter was in line with expectations. And I think that's true. And there is still a tough consumer backdrop. And really what she's trying to say is that there isn't a lot of visibility into the second half of this year. And they did mention that they're seeing softening trends in July, and they've adjusted their 2023 outlook. And you know what? It is what it is. I would suspect that if any retailer right now tells you that they can see into the back half of the year, they would be lying. I just think that this is a very unpredictable market. But the other thing is, like, which market is not unpredictable, right? And so, and this is, of course, where everyone is, or where many of the people who decided to sell the stock, this is why they sold it, to ensure that they have flexibility to continue to fund their strategic investments appropriately. They're pausing the quarterly dividend beyond the board's recently approved October payout. Now, here's where I think this is a little bit of a fib. Remember, guys, that they were saying that, they were going to save or develop savings of approximately $350 million, and then 200 of that was going to go to the bottom line, go to the investor, and 150 million was going to go to the company for their strategic initiatives. So why would you need more money? And I think, as I'm saying that, I guess I get the answer that you would need more money because you're not getting it from the top line as consumer environment deteriorates. So once again, a good move to cut that dividend, at least in my opinion. And just going into the outlook, notice how, the sales, like the top line guidance didn't really change that much. You're just slightly more on the top end of the decline. And so I figured actually that they were going to bring this lower. So I had already taken it down further. Was forecasting it at 12.5% decline for the year, but I'll show you that model in a second, because I'm going to fess up to a mistake that I made in it, and it might help you guys in the future. And so, when it comes to the gross margin, here's where it's a little bit scarier, because they're telling you that they're using more aggressive markdowns. And for somebody who works in finance and just being an investor in general, this is interesting, the wording that they used. I don't think that I would use the word more aggressive markdowns. I think that scares investors. I think you would probably say a more price sensitive consumer, or greater consumer price sensitivity or something like that. That'd be the pro move there. But I'm not going to tell them how to do their job. Now, overall, this is still a profitable company. I'm actually not bad with them not making any money in 2023. And in fact, I'm kind of already mentally preparing myself for the back half of the year to be weaker. I mean, we have higher interest rates, we have a deteriorating economy. Can it get worse than it is today? Absolutely. Can it just stay steady as she goes? Yeah, that could happen too. So I'm really not sure, but I just want to mentally prepare myself for them missing even this EPS estimate, which is the way that I've forecasted the model. And just to give you guys a bit of an idea, so it's really Champ Sports that's the weakness. So their comparable sales overall are down 9.4%, but you can see it's Champs that are down 27.6%, and it's accelerating because year to date is 24.9, 25. So obviously Q1 was much lower than that. So the slowdown in Champs is accelerating. And when it comes to the net debt situation, this is the first thing that I'll look at with retailers, because you know what? It's very difficult to go out of business if you don't have debt. You can always renegotiate lease terms. And so what do they have in terms of net debt? They have, it's not so bad. They got $180 million of cash on hand. Inventories have increased a little bit, but I'm not too worried about inventories. They've always been at around 15 or 20% of, next year's full year sales, but Foot Locker is looking to bring this down. They've just operated historically at a very lean inventory level, somewhere around the 15% of next year's sales level. Right now, they're closer to 20%. So I understand why they're trying to focus on that. And once again, now that you're not paying a dividend, you can really bring this down. And so I really hope they do that, as well as, getting some of this inventory. You're monetizing some of the inventory. You can use some of that excess capital to bring the debt down as well. I mean, it's not a huge amount, but it would still be nice to just have it go to zero. And so you guys can see retail is pretty easy with how you can model it. Overall, I think that, I think we're probably going to see a 10% revenue decline. You guys let me know in the comments how you guys are modeling this out. I'm very interested to see what numbers you'll be using. I'm forecasting a 27.5% gross profit margin. That might be low, that might be high. You guys let me know. Overall, I'm getting to an earnings per share of around $1.20. So that's a huge decline from last year. And then I'm kind of just saying, look, give Mary Dillon time to cook, right? Like, in 3 to 5 years, does this become a $2 or $3 stock, or sorry, a $3 or $4 stock? Because at $3, 3 times 15, that's the average multiple. That's a $45 stock. If it hits $4 and investors are convinced that the $4 is sustainable, well, that's a $60 stock. So that's kind of the way I'm thinking about it. And it's currently trading at around, around that $15, $16 range. So, there's a lot of upside. And when you think about downside, even, there still is downside, trading at 15, 16, it could very easily go to zero if the company goes out of business. But in a challenged environment, it could go to like $2, $3, $4. Like, the market is irrational, but there's an operating company behind this. And what is more likely than not to happen with the operating company? I think over the next 5 years, I do believe that the company goes back to around that $3, $4 area. And so you're either going to have a 2 or a 3 banger, at least in my opinion. And here's where I got to fess up to you guys a little bit. So in the last video, I actually realized this after I made the video. Nobody really said anything to me, but when I was looking at the model again, I was looking at this and I was like, how did I get a negative 12.5% revenue growth, but I still ended up with $2 per share of EPS? That makes no sense. And really what it is I got aggressive on my margins. Now, a 2.4% net income margin, it's much lower than what it was last year. So it's not like it's impossible, but I just felt like in this environment I probably should have taken that down further. And so, especially considering that management was forecasting a lower decline in sales and they were still getting to $2, I remind myself of a VP that I used to work with, and anytime I screwed up a model or I just did something small, he would just laugh and he'd say, "Is this amateur hour?" And so I looked at this and I just started laughing. I'm like, 100% amateur hour. So take a look at the model where it is right now. If you guys don't have access to the model, you guys can get access to all the models at that lower tier of the Patreon, and I would highly encourage you to join us every month on our monthly calls, because I think that's where the real value with this Patreon is. And so the thesis behind Foot Locker, it remains the same. Do you believe that Mary Dillon can recreate the magic that she did at Ulta Beauty? If this returns, like I said, to being a $3 per share company, it's a $40 per share stock. If it returns to being or actually that would be 45 at a 15 times multiple. If it returns to being a $4 per share company, it's closer to a $60 stock. So that's kind of the way I'm thinking about it. I think that, if you're just thinking of it in terms of odds, the upside is likely greater than the downside. There's always risk. So, none of this is a recommendation. It never is on this channel. Do your own due diligence. Let me know what you guys think. What am I missing here in this overall thesis? I just think that this overall looks like a good stock to throw into the portfolio and just, leave it there for the next 15, 20 years. We'll see this thing play out. I think it plays out over the next 5, and then I'll probably end up not holding it for that long anyways, but I'm very happy to just hold this thing for the long term, especially if the company really turns around and you start seeing visibility into the $5, $6, $7 per share area as they start buying back shares, or you even get a nice income yield. If it goes back to $1.60 per share, if I just run the math on that, $1.60 per share on a $15 stock, that's a 10.7% dividend yield that you would get if they reinstated that dividend. And of course, if they keep buying back shares, they would ultimately increase that dividend per share as well, and so your dividends per share would go higher. And so I just see a lot of opportunity here, but once again, I want to know what you guys think. But also, if you want to see the previous video that I put out on Foot Locker, I'll link that one right here.